Hello everyone, this is Huafang Li again. In this short video, we are going to talk about nonprofit finance, focusing on how to develop different financial resources for nonprofit organizations and what can research tell us about the status of nonprofit finance research. So what exactly is nonprofit finance? So basically what we are talking about first, where to get the revenue, income, right? And the second, how to generate sustainable financial resources. And so in the long run, you'll be financially healthy. So the first question I want to pose is, let us think about should small nonprofit organizations manage finance differently or similarly than those big ones? So if your answer to the question is, okay, they should be the same because they are going to get revenues from government, from foundations, from corporations, from individuals, from fee-for-service, or maybe some financial investment returns, etc. Right? So these are the common sources for nonprofit organizations, and usually we would suggest that don't rely solely on one stream of revenues, but diversify it so that it can stabilize or sustainable in the long run. But what's the difference between small nonprofits and the bigger ones? Generally speaking, bigger ones usually they have already diversified their revenue sources, right? So that's why they grow, they become bigger ones. While for small ones, especially when they are startups, usually they just have one main revenue source. Like, okay, they solely rely on government grants. So if they can't find other financial resources, they will be struggle with the money. So if they want to be financially healthy in the long run, then they should manage the finance a little bit different than those bigger ones, because those bigger ones already secured other revenue sources. All right, so for the small ones, maybe they need to develop other sources. So we already touched upon, like, okay, you can generate revenues from fee-for-service, from private donations, from government grants, awards, contracts, etc., or you can get invest incomes. While the other are often overlooked or may not count as revenue sources, will be like the in-kind goods and the volunteers, because in-kind donations, like for instance, you are a food bank and some restaurants donate food to you, so that food is actually can be valued, right? So you can calculate the value. So in a sense, this is also can count as your revenue source, because otherwise you need to use money to purchase those foods. And the volunteer works, right? That's the same. Otherwise, you need to pay, or like pay for the work people do, right? Either by contracting out or by hire someone. Either way, you need to pay for it. So volunteer time that can be actually used towards that, right? So because that work is done by volunteer, otherwise you need to pay for the work as well. All right. So these are the common revenue sources for the nonprofits. Okay, so as we said, the nonprofit sector is very complicated, right? Because different nonprofit organizations, if they serve different types of population, then the strategy might be a little bit different in terms of financial management. So let's think about this, right? So ballet charges high fees in general, right? If you want to watch a classic ballet, then you possibly need to pay a decent amount of money. While if you donate it to a justice project, usually just like $10, $20, etc. Right? So you don't pay as high price as a ballet concert. So why then the difference between these two different like nonprofit programs. Right. One explanation for this is whether or not we talked about like quasi-public goods based on two criteria: rival, non-rival, and excludable or non-excludable. Right. So in general, if that's more towards excludable and more rival, then we would say that's more towards private good, right? If it's like both excludable and the rival, then we will of course say this is private goods, pure private goods, right? But anyway, if the degree is lower in terms of rival and the excludability, then we would possibly say, okay, that's towards private goods, right? So on the other end, then you have, of course, public goods, right? If it is non-excludable, non-rival. So the thing distinguishes Blay from the Justice Project is because the externality, the degree or the levels of externality of these two services and goods are different, right? So we measure the externality, whether or not this is like just a small amount, then maybe that's more towards private goods, and this is a significant amount of externality, then that's towards the public goods. All right, so the Blay here is more towards the private goods, while the Justice Project obviously more towards the public goods. So that's one way of thinking why they price differently in terms of nonprofit financial management. Okay. So on your right side, there's two tables. We can look at like different types of nonprofits. Okay, so these are the nonprofits from Atlanta, just to use the here for example. So on top, that's arts and cultural nonprofit organizations. So you can see that revenue sources are more towards like fee for service and the private goods, right? And at the bottom you have human service nonprofit organizations. Well, that's like vary a lot, right? So if you look at the Families First and the Travelers Aid, these two, you can see a significant amount of money from the government side, especially for the Travelers Aid, right? And for the Atlanta Habitat, fee for service and the private donations is actually like dominates the other sources of revenue. Okay, so but the one distinguishing project here is called Georgia Justice Project. We already talked about this, right? So the majority is from private gifts, and they have a small amount of investment income and other in-kind donations. But this is only counts, if you add them together, only counts like 0.2%, right? So this is really like just not that much in terms, especially as compared to total private donations to the Georgia Justice Project, right? So we already explained why Blay like more than 70% revenue generated from fee selling tickets, basically, and the Justice Project from private donations. This is because of their different levels of externality. All right, so to manage a nonprofit portfolio, financial portfolio, so here you need to think about like are the benefits occurring to particular individuals or groups being captured through appropriate form of finance, such as fee-for-service contributions or government support, right? If it's not, then financial strategical thinking, nonprofit needed to develop such a strategic way to capture these, right? So if you can charge people fee, but you are not doing that, then maybe the next step is just to develop a fee for service strategy, right? By charging, you can charging people at different levels. So you basically say, okay, we are going to discriminate you based on the price, right? So higher income people, we would charge a little bit more, and while if people are in need financially, maybe they can enjoy your service for free. Okay. And so what kind of adjustments in programs and the services might lead to a stronger financial position for the organization? Just as we said, if you're not doing it, but then the opportunity you should do it, then maybe you should do that, right? And the example I want you to think about is how to manage a Goodwill store's finance, right? So the Goodwill store is basically you accept goods from an individual or cooperative donors, and then you clean it, store it, and resell it, right? Then you need to have warehouse, you need to have to staff, cashier, and you need all these sales forces, and so how to manage it financially, right? So that's gonna be challenging for many of the stores. But a Goodwill store is a little bit different because they don't generally pay for the goods, right? So unlike a commercial supermarket, for instance, right, you need to pay for the goods. Then you list in different aisles, then people can buy them. But the Goodwill store, they don't need to pay for the goods, the commodities. All right, so there's no right or wrong answer to this, right? So different Goodwill stores might be also different. Goodwill store in Pennsylvania, different from those in Michigan. So the example is just to push you to think about, like, okay, is this like fee for service, but how to develop overall financial strategy so that can make the Goodwill stores financially sustainable. All right, so to manage the nonprofit financial portfolio, there are several issues we need to consider. First, whether or not this like financial strategy is actually in the line with the mission, right? So you need to consider mission effectiveness, whether or not that's actually promote the mission. And also you need to think about solvency, right? There are alternative revenues and being all considered, so somehow captured by the financial portfolio, and how to manage the cash flow so you don't bankrupt your organization, right? And also you need to understand the relationship between different streams of revenues, right? There might be crowd in, crowd out effects. For example, in the relationship between government and nonprofit, we discussed that there's two different main effects about the government funding to individual donations, right? Whether or not government funding gonna actually crowding in or crowd out individual donations. It varies by different stages, different size, and different service areas. So you need also to consider the indexing effects of different incomes. And also you need to consider your organizational capacity, right? Because if you are managing different financial resources, which means it may increase the transactional cost because you are dealing with multi-stakeholders, which requires more coordination, etc. And also think about the risk management, which is common in business world, but not so common in nonprofit world, right? If we are really thinking about the financial health and the sustainability in the long run, then definitely we need to take risk management into consideration. So one common thing is about like whether or not nonprofits should prepare like rainy day funds, right? Just in case something bad happens, then you have sufficient financial resources to save the organization. All right, so here's the a figure about like the accounts about nonprofit management articles published over the years and across different disciplines. So so as you can see, like especially in between 2010 to 29, so this is projected articles published in nonprofit management, accounting, economic and finance, and public administration. So these are the common disciplines mentioned about nonprofit finance. So if we break them down and list the top 10 financial words in journal article titles by discipline, so you can see funding, giving, service performance, charitable giving, etc. are more commonly seen in nonprofit management. However, in public administration and accounting, they actually focus more on profit and the accounting side. While economics and finance, they talk about the hospitals, and because hospitals are a little bit different, it's a special kind of nonprofit organization. They own huge properties usually, right? They charge fee for service, usually that's the business model. And by reading names, you probably won't be able to tell whether this hospital is a nonprofit, government-owned, or private business. And the crowd here, I believe, is talking about the crowd in, crowd out effects, because this is basically developed by economists. Okay, so some of the more specific issues needed to be discussed in the future is about revenue portfolios and the interactions, especially the crowd in, crowd out, right? So previously we discussed how government funding gonna crowd in, crowd out individual donations. However, if there's like a business contract, right, that may displace the nonprofit goal, might also crowd in or crowd out individual donations, depending on whether or not individuals perceive the working with the private corporation is in the line with the mission, or it causes goal displacement, etc. Right? Or whether or not they believe the business is gonna improve the management quality of the organization, or actually gonna corrupt the organization in the future, right? Or whether or not they see corporate money gonna be complement their donations or gonna substitute their own donations. So there are various things you need to consider about the revenue interactions. Okay, and also if the organization is big and they have surplus and have some money and they can endow, so then you may think about the use of funds, right? There are the benefits and the problems of select resources, and also profits and issues of capital structure. All right, so this is just an overview about nonprofit financial management. So for the details, you need to dig deeper for each aspect. All right, that will be all for this short video. Thank you very much.